Hi, today we'll discuss about the external financial reporting, the first unit of CMA Part 1, external financial reporting. External financial reporting consists of various reports what we you know prepare to make our users known about the financial operations, financial performance, and the financial position of the company. Users of financial statements include management, shareholders who invested in shares of the company, employees who are working for the company, whether the performance of the company is good or bad, can continue with the company or not, financial institutions who lent money to the bankers, um, suppliers who supplied goods on credit so that they want the company position to be strong, customers who are getting the goods and services from the company, tax authorities, portfolio managers, stock exchanges, etc. They are all called as users of financial statements. These users are further classified into internal users and external users. Internal users like management, shareholders, employees, etc. External users include stock exchanges, portfolio managers, any potential investor who is not related to the company and company's operations. Both internal users and external users want to know the performance of the company, want to know the financial status of the company. Whether they are internal or external, like to see the performance of the company. Um, Company's financial statements depends upon the structure of the business operation. The business operation structure can be classified into proprietorship, that is single ownership, partnership, where two or more people form together and run a business. A corporate wherein the capital of the company is raised by issuing the shares, bonds, etc. So sole proprietorship, partnership, corporation, and some organizations like non-profit organizations like cooperative societies and all um, uh, um, have different financial reporting and the registration processes. We are working on corporation side, so we give importance for this. But see, from sole trader point of view, there is only one owner, so that what happens is like the formation of the business becomes much easier. There is no requirement of the agreement. Entire profit is owned or loss is suffered by a single person, and we can have some advantages like a family training can be given, growth is enjoyed by a single person, and he can take decisions, quick decisions. But there are some disadvantages as well, that the sole traders face unlimited liability. Unlimited liability means when the business goes into an adverse condition, where the business is about to be closed, which we call it as bankrupt. Say for example, the sole trader has an asset value 1 million, 5 million, whereas liabilities valued 7 million. So there is a shortage of 2 million. This 2 million will be arranged from the proprietor's personal assets, because business assets are not enough to cover the liabilities. That's called unlimited liability. So this is one of the greatest disadvantages in the case of sole trading and as well as in partnership. Partnership business wherein you have two or more partners who form together, have an agreement to start a business, share the profits in agreed ratio, contributing the capital. The advantages include, as compared to sole trading concern, partnership company can grow faster. Why? Because the knowledge and skills, okay, the contribution of capital are higher as compared to sole proprietorship. But there are disadvantages in the case of partnership. Partnership also faces unlimited liability, same like sole proprietorship. Maybe disputes. Okay, most of the disputes come due to the if there is a no proper deed means an agreement between the partners for all the activities which are carried out in the business. If the deed is not sufficient, the disagreement between the partners will take place. Okay, that may lead to many disputes. A corporation, which is what our subject is, uh, a limited company wherein the capital is contributed by public and other corporate companies. The entities, the individuals who buy the shares of the corporate are called as shareholders. We get we get money by selling the shares and bonds. Shareholders get dividend, and those who buy bonds get interest. A corporate capital is contributed in the form of share capital and debt capital, which is called bond capital, bonds. On bonds, we pay interest. On share capital, we pay dividend. One greatest advantage in a corporation is that the liability is limited, unlike sole proprietorship and partnership. The liability is limited to the extent of the capital invested in the company. And also, the transfer of ownership takes place very easily in the secondary market. Say, for example, Mr. A purchased shares of this company 1 month ago, 50 shares of the company at the rate of $10. Okay, these shares are listed in the stock exchange. This is company X. Company X shares are purchased by A. After 1 month, say for example, the share price goes to 10.5 and he wants to book the profit. Then he can sell these shares to someone in the stock exchange in the open market. So this is a transfer of shares between one investor to the other investor. No way the company is involved. Only company corporate will update the details of the shareholder. That's it. By removing his name, adding his name. A's name will be removed, B's name will be added. Okay. And A or B, whoever it is, the shareholder whose liability is limited in case of bankruptcy, they do not lose what more than what they have invested. That's called limited liability. There are some disadvantages, okay, because the company is managed by the directors, CEO, CFO of the company. So there might be financial scams. Very difficult to incorporate as compared to the sole proprietorship and partnership. Lots of legal issues, etc. Whereas a cooperative society, which is mostly a non-profit organization, which is prepared with the help of a community, okay, and it can be easily set up, but decision making can be difficult. Concentrate on corporations. We know the users of financial statement and also the different structures of business structures. What financial statements include? Financial reporting include. The financial statement of financial reporting consists of various financial statements which give us the profitability of the company, the financial resources and obligations means assets and liabilities of the company, and also movement of cash, that's the cash transactions of the business. So a set of financial statement should give us information on resources, not recourses, resources, obligations, profitability, and movement of cash in a business for a particular period of time. So the financial reporting includes the preparation of income statement, which shows us the performance of the company for a given period, retained earnings statement, which shows us that how the profits are distributed to the shareholders, or if there is a further change in the capital as well. Say, not only the distribution of net profit which is received from the profit and loss account, how much profit we distributed, how much profit we retained in the business. Not only this, there is a change in the share capital as well. Say, for example, we had 50,000 shares in the beginning and we recently issued 20,000 shares. So there is a change in the share capital as well. So in that case, instead of preparing retained earnings statement, we prepare a statement called statement showing changes in equity. So when you prepare statement showing changes in equity, you no need to prepare retained earnings statement because you have a column for retained earnings as well. This is, say, for example, equity, and this is retained earnings. So you have a beginning balance. Okay, you have the equity issued recently this year. Here, dividend paid. Then we'll have closing balances. So either you prepare retained earnings statement if there is no changes in the equity, or if you have changes in the equity, you no need to prepare any retained earnings statement. Then we prepare a statement of financial position, which is also known as balance sheet. Then we need to prepare a movement of cash flows. Okay, a summary or transactions on cash flows, inflows and outflows, which is called as statement of cash flows. Of course, after the preparation of these financial four statements, we need to provide lots of information to the shareholders, investors, and all, that what methods we use, what assumptions we have used, which regulation we used, etc. That needs to be mentioned in the notes to the financial statements. After the preparation of financial statements, add notes to the financial statements. Remember, notes to the financial statements are not to be included for any corrections in the financial statements. It is only for the description or details what we have in our financial statements. So it should contain details of the financial statements information, but not any correction, etc. If you do not have notes to the financial statements, we can say that the financial reporting is incomplete. We can say that notes to the financial statements, lack of notes to the financial statements in our financial statements, we call it as incomplete financial reporting. Now let us learn the statements in detail. To learn this, let us begin with the first statement called income statement. The outcome of income statement is either profit or loss. So it shows the performance of the company for a given period of time. Say a year, a month, a quarter. Performance, we call either it a profit or loss. If performance is favorable, we call it as profit. If it is unfavorable, we call it as loss. And remember, the income statement is prepared using temporary accounts. Temporary accounts means the nominal accounts which won't be carried forward to next year, won't be carried forward to the next period. So nominal accounts include only revenues and expenses. Why these are called temporary accounts? Why? Because the revenues and expenses are summarized, the expenses are matched with the revenues, and only the surplus balance is transferred to next period, but not individual accounts. Say, for example, we have our revenues of say 1 million, expenses of say, for example, 800,000. Only the difference, this difference is called profit that will be carried forward to next year, but not revenues nor expenses. That's the reason why they are called as temporary accounts. So no revenues like sales account, no expenses like salaries, printing account, etc. will be carried forward to next year. We carry forward only the net result of this difference. That's the reason why all the accounts which we consider here in the preparation of summary of revenues and expenses are called as nominal accounts or temporary accounts. Stationery is a temporary account, nominal account. Insurance is a temporary account, nominal account. Will not be carried forward to next period. Only the difference is carried forward to next year. An income statement can be prepared either using a single step or a multi-step. Single step income statement describes only the summary of revenues and summary of the expenses. They do not give you this method does not give you the classified profit at different levels. We are just considering the total revenues and total expenses, compare both, and the resulting figure we call it as either net profit or net loss. It doesn't give you a proper meaning because you do not have a classified revenues, total expenses. We don't know what is the expense incurred on admin, what is the expense we incurred on cost of goods. When we do not know cost of goods, obviously we cannot know the gross profit. But here we have total expenses, no classification of expenses. Therefore, we cannot know gross profit from this preparation. We do not know what is selling and administration, selling and distribution, taxes, interest, etc. All these amounts are summarized as total expenses. That's the reason why it is not allowed for external reporting, because it does not give you a classified profit. That's the reason why the public limited companies prepare financial statements in a standard format. A standard format is allowed for external reporting, which begins with the name of the company, name of the company, name of the statement, which statement are you preparing, and period of reporting. So remember, name of the company, name of the statement, and period of reporting. The company may be an MNC, multinational company, operating the business in different countries, deal with different currencies. In that case, what is our reporting currency? Say, for example, our parent currency is from the US, parent country is from the US. So the reporting currency should be mentioned here. Amount US dollars. If you have amount in millions, you can round them off using 000. It's common. So remember, name of the company, name of the statement, okay, period of reporting, then period of currency, reporting currency. Then begins with your net sales, means after returns, cost of goods sold. Say, for example, you are selling the goods 50 pieces of articles, 50 pieces, this is the sale value. But what is the cost of this 50 pieces when you purchased? That is cost of goods sold. When cost of goods sold is deducted from sales, we get gross profit. Gross profit is not a take-home profit. Gross profit is only a difference between sales and cost of goods sold. But we still have so many expenses to be deducted. Okay. Operating expenses to operate the business, administration department, sales department, distribution department. Distribution department means when we purchase the goods, we spend money to move the goods from the supplier place to our warehouse. They are called as direct expenses. These are all called as direct expenses will form part of cost of goods sold. And now we sold some of these goods, we are distributing this goods to customer place, home delivery. These expenses are called as distribution expenses. When you spend the expenses to bring the material from the supplier place to our warehouse, we call it as direct expense or transportation in, which is part of cost of goods sold. But when we sell the goods and spend money to distribute the goods to the customers, we call them as distribution expenses, like uh, courier charges, transportation charges, or delivery charges, delivery truck repairs, maintenance, delivery truck driver's wages, all the expenses, in other words, to move the goods from our showroom or warehouse to customer's place are called as distribution expenses, which is a part of operating expenses. So when you think of OPEX, operating expenses, think of ASD, admin, selling and distribution. Deduct from gross profit. When you deduct OPEX from gross profit, the resulting figure is called as operating profit. Operating profit is also known as EBIT. EBIT stands for earnings before interest and taxes. As the name suggests here, earnings, that is profit before interest and taxes. So deduct interest. Interest is an amount which is paid on the borrowings. Like when you raise capital for our company, we issued bonds. We have bank loans to purchase assets, etc. We might have issued some debentures. Debentures and bonds are same, but debentures are fully secured. Debentures are unsecured. We pay less interest on this, we pay more interest on this. Anyway, all the interest which we pay on these components is called finance cost, that should be deducted from EBIT. EBIT minus I gives us profit before tax or earnings before tax. Then this amount is subject to tax. Say for example, if this amount is $100,000 and in our jurisdiction we have 40% tax rate. So here tax will be $100,000 before tax times 40% tax. So deduct 40,000 and the net income is 60,000. This 60,000 is to be shared among the shareholders who invested in this company. Say for example, we have 10,000 shareholders. Each shareholder's share of profit is $6. This is called EPS, earning per share. Earning per share. If you have 100,000 shareholders, then it is going to be 60 cents. Earning per share is 60 cents. So number of shares is the denominator, net profit is the numerator to calculate EPS. EPS, to show the EPS on the face of the income statement, it is mandatory that we need to show that what is the earning per share, what each share earned in the profit during the year. Now we arrived at, say for example, 60,000 net profit, and how this profit is distributed to the shareholders. The profit is to be distributed to the shareholders by preparing a statement called retained earnings statement. So in my previous example, we had a net profit of $60,000. Before that, last year we had an amount of, say for example, 15,000 retained in the business from the profits. So that's called beginning retained earnings, opening balance. This year profit is 60,000. Our company passed a resolution that we are going to pay 40% of this as dividend. So 50,000, 15,000 the beginning amount. Current year profit is 60,000, of which 40% is distributed as dividend. So we will be paying 24,000 dividend from 60,000. So ending retained earnings balance is going to be 15 plus 60, 75 minus 24, 51,000. So 15,000 will be the retained earnings in this year at the end of the year. That will go to balance sheet. So retained earnings statement always shows you that what portion of the profit still retained in the business. Now in the income statement, if you observe, we deducted cost of goods sold from the sales. Clear? Cost of goods sold. What is cost of goods sold? Say for example, you might have sold 5,000 pieces at the rate of $50. $50 is your selling price, but what is your purchase price? Then only we can say the difference if this purchase price is less than the selling price. Purchase price was say $30, but $30, where is it available? At supplier place. We move the goods to our warehouse by spending say for example $10. So your cost of goods sold is $40. Selling price is $50, giving us a gross profit of $10. $10 per unit. It is giving you $10 times 5, $50,000 gross profit. So the cost of goods sold can be calculated with the help of a formula, that is beginning inventory plus purchase of goods. If any purchase returns are there, that should be deducted. Purchase discounts should be deducted. This is a net amount of purchases. But before that, we have some opening balance of inventory. So opening balance of inventory plus purchases and any unsold goods at the end of the year. Okay, that is ending inventory. Ending inventory should be deducted to get cost of goods sold. So cost of goods sold equals to beginning inventory value plus total cost of purchases minus ending inventory value. This gives you cost of goods sold. The calculated cost of goods sold is to be deducted from sales to get gross profit. Sales minus cost of goods sold gives us gross profit. The advantages of income statement includes, first of all, it gives us the performance of the company. Based on the income statement, we can take steps. Based on the income statement, we can make our shareholders happy, employees happy, management happy. But there are some limitations of income statement. Limitations of income statement include the items that might be relevant but cannot be reliably measured. What does it mean? Say for example, in my previous example, I said that we sold 5,000 pieces at the rate of $50. This is only a monetary issue. It's only a monetary. What about the brand, the reputation, the loyalty? Loyalty is not mentioned here. Loyalty is a non-monetary item. It's a brand recognition. You have, say, for example, Nike. So this is a brand. The brand value is not presented in the income statement. Only the monetary value. Okay. And also, when you want to compare your profit with your competitors, your industry averages, etc., it does not give you a proper meaning or proper base. Why? Because some companies may use the inventory using FIFO method, first in first out method, and some other companies may use LIFO method, last in first out method. So different methods use different companies use different methods, therefore the result can be different. It's purely depending upon the cost flow methods used by the companies. Okay, and some numbers purely depend upon the judgments, estimations, etc., the forecast and all. Some companies may use depreciation using straight line method. Some companies you may use depreciation using reducing balance method. So you need to recognize the limitations of income statement. Okay, income statement only gives about the performance of the company in monetary terms, giving the profit at different levels. And also we came to know that the EPS calculation, it is mandatory all the companies to show the earning per share on the face of the income statement. The income statement preparation should end with EPS calculation. EPS equals to net income divided by number of common shares. I mentioned here preference dividend as well. Why? Because the equity consists of share capital. Equity consists of share capital. Share capital can be raised by issuing two types of shares: preference shares and common shares. Common shareholders are the ultimate owners and lifelong owners of the company, whereas preference shareholders buy the shares for a limited period, say for example 5 years. So while selling the preference shares, we clearly mention that 8% 5-year preference shares of $100 each. So those who want some fixed income from the company, irrespective of the profitability of the company, buy the preference shares. Means the preference shareholders get 8% on the amount invested, irrespective of the profitability of the company. Whether the company gets huge profits or less profits or no profits, still 8% of $100 is calculated. $8 is calculated. Okay, so they will get they will get $8 under any circumstances. They are called as preference shareholders. Now in my example, I'm giving you example like preference shareholders are there in the company and also common shareholders. Say we have $60,000 net profit. We have preference shareholders. Say $100,000 worth of preference shareholder is there at the rate of 8%. So we pay $8,000 to the preference shareholders as preference dividend. Remaining 52,000 only, this 52,000 divided by, say for example we have 10,000 common shareholders, so it is going to be 5.2. So each shareholder, common shareholders share is earning an amount of $5.2. $5.2 from this amount, how much of this will be distributed, how much of this will be retained in the business, that you will come to know by preparing a statement called retained earnings statement. Retained earnings statement. Now retained earnings statement is prepared, showing that how much dividend is paid from the current year profit. Before that, what was the retained earning and what is the retained earnings retained earnings at the end of the year. This amount, retained earnings at the end of the year, will go to balance sheet. Okay, so income statement gives us net income, that should go to retained earnings statement. Retained earnings statement gives us ending retained earnings, and that should be presented on the balance sheet. And all the information on these statements is presented and used in the preparation of cash flow statement. So these are all integrated statements. The order of preparation should be income statement, retained earnings statement, statement of financial position, and cash flow statement. So 1, 2, 3, 4. It should be like this. So first of all, we should prepare income statement. In the income statement, what we mentioned was, if you remember again, we mentioned sales, cost of goods sold is deducted from that to get gross profit. Gross profit is subject to operating expenses, that is admin, selling and distribution. We deducted admin, selling and distribution to get EBIT, earnings before interest and taxes. We deducted interest to get EBT. We deducted tax by calculating the prevailing tax rate to get net income. Listen carefully. If this company has any discontinued operations during the year, and this company faced any extraordinary infrequent items which do not happen every year, every period, we should not call it as net income. Do not call it as net income, because we still have two more points. There might be a loss or gain from discontinued operations due to discontinuance of a product line, a branch, a division, etc. There might be a loss due to extraordinary items like floods, earthquake, okay, any disaster, natural disaster, etc. So in that case, this net income, what you found by preparing income statement, is going to be income from continuing operations. Income from continuing operations. Same net income, amount is same, but the title changes to income from continuing operations. Then gain or loss from discontinued operations. Then extraordinary items. From continuing operations, take C. Then D, E, extraordinary items. The combination of C, D and E is going to be called as net income. When we have D and E, please do not call this amount as net income. Call it as income from continuing operations. Then adjust discontinued operations result and extraordinary items result to get net income. So net income equals to C plus D plus E. And it is to be prepared in the same manner how we prepared in our income statement. Like you can extend your income statement a little head. Like this is my income statement, and it is going to be extended like income tax, okay, before tax, income from continuing operations. Before that, cost of goods sold, and I just left that because you know already. So from here, income from continuing operations, now you should continue giving discontinued operations. Discontinued operation, like one of the divisions is discontinued, on which you have a tax saving amount of say say 140,000. Then the disposal of chemical division, you have a 70,000. The total is 200 and how much? 210,000 plus 140, 350,000. So 560,000 is not net income now. It is income from continuing operations. You have discontinued operations. Likewise, you may have extraordinary items which are of infrequent nature, means do not happen every time, non-typical, okay, and it is purely not at all subject to management decision because it is not in our control. They are all to be presented on the income statement, okay, like this. So you have as per the previous calculation, remember, this is income from continuing operation, supposed to be net income. If these two items are not there, then this is a discontinued operations result. There may be a gain or loss, okay. If it is loss, then you should deduct it. And there is an extraordinary item of say three the 49,000 should come here. So your net income now is 301,000, which is 560 continuing operations income minus 210 minus 49. So you no need to prepare two different pieces like income from continuing operation, then net income. No, you can just extend your income statement. Your income statement length will increase. That's it. So income from continuing operations, discontinued operations, and extraordinary items will give you net income. this is the end of the session today. I hope you understand the preparation of income statement with income from continuing operations, discontinuing operations, and extraordinary items. We'll see in the next session. Thank you, and have a good day.